Welcome back to the Run the Numbers podcast. And let me just start by saying that there is no good time for an S1 to drop. I mean, don't get me wrong. I love when an S1 drops because I'm a nerd for this stuff. And we do want more IPOs because I'm a fan of business and it's exciting stuff. You know, the whole world of monetization and commerce. And I'm losing my mind. I don't know what I'm talking about. But basically, this one dropped while I was in Disney World with two screaming children, and so, dropped on a Friday, which, that sucks. Okay. Now I gotta write this over the weekend. And then, I'm also sharing a small hotel room in Orlando, the 4 of us cooped up in there. So I'm trying not to wake up my wife and my kids with the glow from, my trusty Lenovo as I'm reading through this epic S1 here. But no rest for the weary. I'm your guy when an S1 drops. So I'm excited to give you a breakdown of this one. This is gonna be the Klarna IPO preview, baby. Let's get into it. So, Klarna, as many of you know, buy now, pay later, pretty similar to a firm's business model. And they're a giant in this space. There have been a lot of companies who have tried to do this. Klarna and Affirm have probably done it the best. They're out of Sweden originally. They're about 20 years old as a company, which many people don't realize. They've been around for a while. And they're going to go public on the New York Stock Exchange while being re headquartered in London, actually. And so they've seen explosive growth since COVID. Do you remember like everybody wanted to buy a Peloton, but not pay for it until that stimulus check hit? So you would see the Klarna button like, hey, do you want to make 17 million payments of $4? Yeah, interest free. Woo. And this is a timely move because they're actually going to get less regulatory scrutiny since the Consumer Financial Protection Bureau, which is supposed to protect people from like payday loans and stuff, along with a whole other gaggle of other government agencies, was effectively just like control alt delete by the new presidential admin. So they're looking at this like, oh damn, like the market is great for a company that operates in a deeply regulated space, and I wouldn't call it shadowy, but some people are a bit down on what they do. Their mission is to modernize payments, remove friction, and let consumers buy now and pay later without credit card debt. And many people will say, okay, yeah, like it's less credit card debt technically, but are you encouraging people to buy stuff that they couldn't afford in the first place? Is this actually bad for people's personal financial health? And so in the S1, they say late fees, we minimize them. Revolving credit eliminated. Our buy now, pay later BNPL features save consumers billions in interest compared to using credit cards. In recent years, they've actually evolved past just buy now, pay later. That's where the bulk of their money is still made, but they're now a finance and commerce ecosystem, which includes payments, shopping insights, and banking services. And so, just a few years back, they were valued at an astounding $46 billion. I'll say it again, $46 billion, and they were less than half the revenue size they are now. Their expected IPO valuation is they're hoping to float around 15 billion to 20 billion. And this is just a reminder for everybody of the changing market sentiment in their business model and fintech's business models, plural, ties to interest rates, right? And so they're betting that their brand, scale, and all these new business lines that they've introduced since then will convince investors that, hey, we're not subprime lending in disguise. We're actually a complete financial platform and a net positive for society. And so the quote here from their CEO in the intro, I think, was really good. He said, there is a long list of skeptics out there. People who have never used our service criticize it as promoting debt. What they miss is this: credit cards lump all your spending into a single bill, encouraging larger balances in revolving debt. Klarna, by contrast, lets you decide on a purchase by purchase basis whether to pay now with debit or use credit with clear fixed terms. It's a difference that keeps the average Klarna balance at $87 compared to $6,730 average credit card balance in the United States. All right, so how do they make money? I know I said buy now, pay later, but that's kind of just like a long acronym. And you may be out there like, I don't want to be the stupid one to ask this question. So I'll ask it for you. So, how does Klarna make money? What is buy now, pay later? So, they offer short term installment loans to consumers and they charge the merchants a fee. Okay. So, like the Peloton, they would pay for facilitating those transactions. And they make money primarily from merchant fees, typically 3% of every transaction. These are interest bearing financing for consumer instruments. And they have the growing advertising and data insights business, but most of it does still come from the BNPL side. And while consumers benefit from quote unquote interest free options, it's the merchants who pay the bulk of Klarna's fees in exchange for higher conversion rates, larger basket sizes, and access to Klarna's shopping network. So like the basic thinking here, guys, is that merchants are willing to pay like a few points of their margin to get consumers to buy 97% of a product that they wouldn't have originally, right? So what happens is Klarna will collect uh, or basically prepay the merchant $97 on a $100 purchase, and then once the person who is the end consumer pays Klarna back over time, they hopefully get 100% of what the original price was, $100 over time in different installments, and they end up netting $3 on that purchase. So that's just a hypothetical example. And so in the S1, it says revenue is influenced by three factors. The primary and overarching factor is growth of GMV, that's gross merchandise value, on which we generate transaction and service revenue, followed by advertising revenue from the use of the Klarna app and consumer service revenue from the use of Klarna Plus. That's a subscription format of what they have for consumers. So some of the key metrics here. Gross merchandise volume 105 billion in fiscal year 2024. That was a 14% year over year increase. Total revenue 2.8 billion. So that's what they actually get, right? So 105 billion in total stuff passing through. They get to keep 2.8 billion, and that was 24% year over year growth. Their take rate, so that's the revenue as a percentage of the GMV. Like I said, it's around 3%. It was 2.7% last year. And their US revenue of that 2.8 was 850 million. This portion, folks, is growing 39% year over year, and that's their largest market. Okay. So really doubling down on the US market. And you can see that because they're burning a lot of cash to do so. So Klarna, they're monetizing transactions more efficiently, you can tell, getting more out of each transaction. And so their take rate went from 2.3% just 2 years ago in 2022 to 2.7 in 2024. So that means they earn more revenue per dollar of transaction volume. In 2022 to 2023, revenue grew 17% year over year. 2023 to 2024, it grew 24% year over year. So then you look at that and you say, well, gross merchandise volume only grew 14%. So that actually means that revenue growth is outpacing transaction volume growth. So how do you do that? It's largely due to increased late fees and financing charges, which is a key regulatory risk if that environment changes, and growth in advertising and merchant services revenue. So while this is a positive trend for short-term monetization, it does raise some long-term questions about whether Klarna is over-earning on fees. So keep that in your head. Are they actually charging too much? As Sam Walton used to say, your margin is my opportunity. This could draw regulatory scrutiny or push merchants and consumers to work with lower cost providers, right? Like if the suppliers like a Peloton, like I said, is they're like, well, you just keep jacking up rates on us. Like we're gonna go to a firm or somebody else. Like that 2.7% could just be a temporary thing until the next player comes along. Okay. So profitability and cost structure for Klarna. Net profit in 2024 was 21 million. This was their first annual profit after years of losses. Now, I'm going to put huge quotation marks around that. It technically was a net profit margin, if you read the financial statements straight up, of 0.7%, so just under 1%. But they had an operating loss of 121 million, which was less than the 323 million they lost in 2023 and less than 980 million. Oh, wow, almost $1 billion in 2022. And so they did turn this small net profit, but the core business remains unprofitable once you count credit losses and stock-based comp. Okay. Yeah. They're not counting credit losses in there, like the key risk to being a buy now, pay later. And so consumer credit losses were almost 500 million. That was up from 350 million in 2023, and it represented 18% of revenue. So their losses on these loans to people, like I said, like they're fronting the money to the supplier and like 97% of it, they don't always get the $100 back from the end consumer. Okay. $500 million worth, they did not get back. Sales and marketing spend was 328 million in 2024. This actually went down year over year from 381 million and down again from 531 million in 2022. So if you look at that, both in absolute dollars and as a percentage of revenue, their sales and marketing investments are going down year over year. Interesting. All right. And their technology and product development was 444 million, larger than what they're putting into sales and marketing, up from 389 million in 2023. So the R&D spend actually went up. And so Klarna has been famous for coming out in the media and saying, listen, we're using AI to drive down the cost of software and actually building a lot of stuff internally. And their CEO proudly announced in late 2024 they were actually dropping Salesforce and Workday. So dropping Salesforce as their CRM and dropping Workday as their HRIS, like core systems of record, to build them internally using AI. But once again, rising credit losses, that raises concerns about loan performance and how much they're reaching into riskier cohorts to grow revenue. And what I mean by reaching into riskier cohorts is, like, do we have to extend these loans to people who won't pay us back in order to increase our surface area for revenue? Okay, so liquidity and funding, they do have a banking advantage. Klarna is a bank. They have 3.2 billion in cash on hand, and they have consumer deposits of 9.5 billion. Okay. So unlike a firm, Klarna has a banking license. That's not easy to get. That is a competitive moat, and it allows them to fund loans with consumer deposits instead of expensive debt. And it probably means that their podcast commercials are a lot shorter without all the disclosures. But nonetheless, they say our license enables our differentiated funding strategy by allowing us to fund 94% of our financing products in 2024 by utilizing deposits, which are highly stable and lower cost than other non-banking funding strategies, such as asset-backed financing. So if you look at a firm's balance sheet, they have to use a lot of debt in order to extend these loans. Klarna has a different advantage in the sense that they can use consumer deposits. Okay. Um, so significant cost advantage, but if you're a bank, you also have higher regulatory oversight, right? And the risk is if deposit growth slows, Klarna could be forced to rely on higher cost debt financing, which would reduce its margin advantage over competitors like a firm. All right. So, by the way, side note, if any of you are at home and bored, bring up this S1 because it has like some of the most unintentionally funny photos in it. There's just like this random cat on a record player. There's this floating dog head with someone's like arms in a sweater. It's bizarre. And there's a man that kind of looks like Rick Rubin cruising in a Jeep. So I don't know. It's a vibe. It may also be the inland tuna poke bowl I rolled the dice on at dinner last night. Nonetheless, let's compare Klarna and Affirm. I think they're strong comps. So Klarna grew their revenue in 2024, like we said, 24% year over year to 2.8. Affirm grew 37%. So they were a whole 13 percentage points higher year over year to 2.23. So they're not that dissimilar in size. Klarna is half a billion larger, 500 million in revenue larger, but Affirm is growing faster. Uh, Net profit and loss on paper, like we said, Klarna claims a $21 million profit in 2024. That's not real. And Affirm had $139 million loss. Gross margin, Klarna was 27%, Affirm 50%. That's beefy. That's a nice margin. Credit losses, Klarna about 500 million, which is 18% of revenue. Affirm also about 500 million, which is 23% of revenue. And funding model, like we said, Klarna is a bank, 9.5 billion in consumer deposits to leverage, and Affirm 5 billion in debt financing. 7 key themes. Ooh, we're gonna get spicy here. So they're going public at a fraction of its peak valuation. So 2021 valued at 46 billion in the private markets. Private. Now it's targeting a 15 to 20 billion dollar IPO valuation. And so I think it's like a reality check for a lot of later stage fintechs, not just like Klarna, it's just one company, but there were a lot of fintechs that had these models that I think, we expected them to rip at scale, but with interest rates changing, it's just not the same. Next one here. Klarna's AI driven cost cutting is fueling margins more than revenue growth. That's right. Fueling operating margins more than actually fueling revenue growth. So their margin expansion is coming more from automation than just like selling more. And so they have this AI powered customer service that they're touting. They say it handles 62% of inquiries, which reduces headcount in customer support. Then they have this AI driven CRM that they built. They said, we slashed $7 million per quarter in marketing expenses. Sorry, Salesforce, no more dollars. AI underwriting helped reduce risk while improving approval rates. So they're saying like, we're not just a credit, like buy now, pay later company. We're actually like an AI company inside and out, not just the way that we sell, but also the way we operate. And so they're trying to push this whole narrative of AI first financial platform, both internally and externally. And like I said, 14% year over year decline in sales and marketing and 15% decline in customer support costs, which is impressive year over year to slash costs by that much and still grow your top line by 24%, even if a lot of that is driven by increasing take rate. All right. Klarna's banking license, like we said, funding advantage, but comes with risks. The deposits surged from 63 million in 2022 to 343 million in 2024. That's huge. And that's a sign the funding advantage um, like it's dependent on how much is coming in there, right? It can't be taken for granted. And they must also comply with this fancy thing called Basel III banking regulations. It basically was like the set of international banking regulations that came out of the '08 crisis, which limits their ability to take certain risks. And so banking model makes them more stable, but also subjects it to tighter oversights internationally, even if the US Consumer Financial Protection Bureau eases off for a couple of years there. Number four, Klarna's US expansion is its biggest opportunity and also its biggest risk. So Klarna's US revenue grew 39% year over year and surpassed Europe in scale, but the US credit losses are rising faster than in Europe. That's right. We got more deadbeats in the US, and that adds risk to loan performance. And so while merchant funded loans are their primary revenue stream, they also make money on fees when the consumer portion of the transaction fails to pay them back on time, right? Like they'll charge late fees on that, and that can actually be more lucrative. Like they want to make sure they always receive their money back at the end of the day, but sometimes it's actually better if it's later because then they can kind of double dip on both the take rate from the supplier, like Peloton. I just keep using them as the example, and then also a fee from the customer. So you're monetizing both sides of the transaction. But I mean, they have a lot of competition from the likes of Affirm, Apple Pay Later, and PayPal for market share. So there are competitive headwinds. Number five, they're quietly becoming an advertising and payments platform. This is perhaps one of my favorite things that I picked up on in the S1 because they're expanding into these high margin merchant services, which positions it to be more than just a buy now, pay later. And that starts with Klarna ads. So they charge brands for sponsored payments similar to an Amazon ad model and checkout monetization. So they promote certain payment methods in exchange for fees and retail data and insights. So they have this AI driven shopping analytics platform that they will sell to merchants so then they can sell even more on the Klarna platform. So like the beauty of building a two-sided market here is advertising emerges as a high margin opportunity at scale. It's not like the biggest technical risk to build this advertising model, but like you can't do it unless you have this competitive advantage of the eyeballs uh, from people who are coming there for something else originally. And so they said advertising revenue reached 180 million in 2024, or 6% of our total revenue. That's actually pretty significant, right? High single digits. Number six, Klarna's accounting and internal controls raise red flags. That's an understatement. So they disclose material weaknesses in internal controls related to one, user access and system changes. Ooh, fraud risk. RevRec, which requires heavy auditor scrutiny, and credit loss estimates, which may be understated. So they actually won't have an external auditor of internal controls until 2026. Yikes. Meaning investors won't get full transparency for about 2 years. By then, like, who knows where the stock will be? And then it's like, ooh, what was going on inside this thing? So that's a really big deal. The next quote that I picked up on in the S1 that I wanted to call out to you guys is we have identified a material weakness in our internal control or financial reporting and may identify additional material weaknesses. Oh my goodness. In the future, or otherwise fail to maintain an effective system of internal controls. I can't believe they printed that. Number seven, Klarna's insiders and VCs have cashed out a lot. Will they keep selling? So insiders and early VC investors estimated to have taken about 800 million already in secondary sales off the table between 2022 and 2023, which is fine. Get yours. But Sequoia Capital, they took 135 million of Klarna shares off pre-IPO. And then co-founder Victor Jacobson sold 73 million. CEO Sebastian Simakowski sold 56 million. And then as a result of keeping people like their heads in the game over time, stock-based comp surged to 50 million in 2024, which dilutes current shareholders. So with many insiders already cashing out, you got to ask like, will they continue selling once the IPO lockup expires? And also like how large will stock-based comp weigh in future years as the company looks to keep personnel motivated, especially after 20 years of building the company? Some of these people have been there for a while. They might be tired and they might want to get a payday. All right, so where will Klarna trade? Let's check in on the valuation here. So, as a reminder, PSA here, not all fintech revenue streams are valued equally. So, higher multiples will go to hybrid SaaS plus online payments, processing, right? If you do SaaS plus payments processing, that's really valuable. You get the recurring and the reoccurring revenue streams. So that's the Stripe, Shopify, Brex Premium has an offering there, and Toast. They pair those two together beautifully. Moderate multiples go to those with interchange fees, like a Brex, a Chime, or FX revenue, which would be a Wise, a Stripe for the cross-border payments. And then lower multiples go to interest revenue, like a Mercury, and a buy now, pay later, or lending platform like a Klarna or an Affirm. So Klarna might be able to get Affirm's current 7x forward multiple despite some lower margins and lower growth and some profitability concerns, but it should trade much higher unless something goes wrong than PayPal's consumer like 2 to 3x revenue, given its that diversified business model. So some potential red flags here. Their adjusted profit excludes some like wildly key costs, which makes profitability look much better. Since they're now UK based, they rely on IFRS, I can never say that one, IFRS accounting standards rather than GAAP. And they heavily rely on non-IFRS metrics that exclude stock-based comp, restructuring costs, and IPO expenses. So if you look at the bridge that they did here, it may be a bridge too far. Klarna's adjusted operating profit in 2024 was 181 million, but under IFRS, it was a negative 121 million dollar loss. That's right. So if you take a look at it, they back out depreciation and amortization, share-based payments, severance-related restructuring costs. Severance seems to happen every year, and then IPO-related costs, 15 million. Wow, in 2024, and that gets them to 181 million in adjusted operating profit, or 6.4% of adjusted operating margin. Right, so they managed to go from negative 4.3% or negative 121 million to 181 million. Quite the add back there. And then if you take a look at their transaction margin metric that they tout, it excludes credit losses, making it appear more profitable. So that to me feels like a rope-a-dope, because if your business model is lending, the key risk to sustainability is people actually paying you back, which I think you get the point there. And they don't include marketing rebates and revenue calculations, which means the real merchant fees may be lower than reported. So this effectively understates the real sales and marketing costs. So the net here, Klarna's numbers may inflate its true profitability or lack thereof, and you need to do your own homework and adjust accordingly. The next thing here, they're quietly securitizing the buy now, pay later loans to free up capital. So they go and package and sell the BNPL receivables to investors, what they expect to get. And that's similar to how banks will securitize credit card debt to get it off their balance sheet. So it's this whole like Big Short thing over again. That movie is incredible. And you can securitize anything. Exciting. So this reduces their balance sheet risk, but it exposes it to market demand for these securities. And if the cost of securitization rises, their lending margins could shrink. And they also engage in synthetic securitization, which is way too smart for me to really fathom. But I think what it means is it transfers credit risk while keeping loans on its books. And as of 2024, Klarna has 867 million in securitized loans that don't appear on its balance sheet. And so this matters because it frees up capital, like we said, but it means investors, you can't see the full extent of their credit exposure, especially if portions are off balance sheet. Whenever you hear off balance sheet, be like, ooh, hey. Next one, Klarna moved its parent company to the UK right before the IPO. Why? Well, redomiciling, going from Sweden to UK, that changes its legal and regulatory structure. And it probably makes M&A easier, as Klarna is now under the UK financial regulations instead of the Swedish banking laws. If it was on a spectrum, I'd say like UK financial systems are probably a little more lenient than Swedish, but not as like commerce or business friendly as the US may be. And so a corporate move right before an IPO, it does often raise questions. Was this done for regulatory arbitrage, tax benefits, or investor optics? But just know that's where they are. And their CEO's family charity has received millions from the company. Maybe they're doing good things, though. I don't know. Maybe I shouldn't say anything bad about this, but they have paid over 7 million to entities connected to the CEO's wife, Milky Wire AB, 1.6 million over 2 years for environmental services. Then they donated 3.8 million in 2024 to World Foundation, which doesn't have any vowels in it, where his wife is a board member. And it's important to note that the board approved these transactions and the CEO is excluded from the vote. So it happened like he didn't put his finger on the scale there to say give these places money. But it still matters because it's a related party transaction and it does have a corporate governance overhang to it. So how will this trade? None of this is investment advice. This is me just trying to figure it out in the back of a bar napkin in Orlando in between Disney World runs. But Could it be 25 billion valuation, which would be a 7 to 9x forward revenue multiple if you assume, hey, they grow at 20% year over year again, get maybe to 3.3, 3.4 billion in revenue. In this scenario, they would successfully transition from a buy now, pay later lender to a diversified fintech platform. They get credit for that and they expand their services. AI driven automation will fuel margin expansion, which improves profitability. Klarna can scale its advertising and merchant services with more eyeballs, driving incremental revenue. And their banking license, that's a big advantage. Can they tap into that over time? And maybe regulators will say, hey, you do you. We're not going to mess with you. And that allows them to rip at scale and underwrite more loans. So yeah, could they trade at 7 to 9x? Possible. Uh, what's the base case here? Probably somewhere in the 4 to 6 territory, which would be 15 billion to 20 billion. So they remain a leading buy now, pay later player, but they struggle to break free from what many people put on it as a stigma and as a lending heavy model. And so take rate stays steady, but growth slows due to regulatory constraints. AI efficiencies may not pan out at scale. And maybe Apple Pay comes in and caps pricing power. Klarna's banking license could keep funding costs lower than a firm, but deposit growth slows. Remember, it's a two-part equation there. And the US market is competitive, right? There are headwinds there of others coming in. And so maybe they trade at more of a 4 to 6 forward revenue range. What's the bear case? What could get ugly here? If they trade in the 10 to 12 billion range, which would be 3 to 4x revenue, which is closer to PayPal, in this scenario, they would struggle with rising credit losses, increased regulation, and funding cost pressure. If the credit losses go up, like that's not good. If regulation goes up, that's not good either. And can they keep the funding cost advantages over time? And how real are these AI efficiencies? Can you bleed a stone after a certain point, right? Maybe they trade in the 3x range, which is more like a fintech such as a block. So, some final thoughts here. I think a strong debut could reopen the IPO market for fintech unicorns like Revolut, Chime, and Stripe. Not that Stripe like literally ever wants to go public. So yeah, whatever. But even though we keep wishing it, and more importantly, I think their IPO will be a bellwether for whether public markets are ready to embrace fintechs again or if the sector remains stuck in a cycle of high growth skepticism. So, investors will be watching closely to see if Klarna is a category defining fintech platform or just another lending business fighting an uphill battle against regulation and credit risk. I hope you enjoyed this one. I rewarded myself with a churro and a turkey leg in the Magic Kingdom after writing this. None of this is investment advice. I do have heartburn from the churro. Talk to you soon.